The market still very much is fueled by independent buyers.
Generally speaking, FNTs for mixed practices were a good 100k up on private practices and NHS practices.
Big dental groups actually have probably took a step back in acquisitions.
79% of transactions have been to independent purchasers.
Buyers are paying a greater multiple on higher turnover practices.
It's that time of year. We're about to release our interim Goodwill Report, which covers all of the transactions that we've acted on that have occurred in the first half of the fiscal year, ending the 1st September 2024. So you can get a copy of the report by clicking on the link below this video. But Phil, what are the headlines?
I guess the first thing to say is the market still very much is fueled by independent buyers. So if we look at the data, now 470 individual practice owners own 2 or more practices, and that's increasing. So when we're looking at the purchases on the ground, is what we're seeing is the vast majority are going to individuals that own a site that are looking for their second site or looking to expand a micro-consolidated group within the market. Maybe these buyers have paid off some debts, they're in a really good position financially, and they're looking to expand and grow the business. So I guess that's the first key stat. That's really, if you look at 470 individuals owning 2 or more practices, that represents 8% of the market. So that shift is now, we're not near them catching up the groups, but it's certainly showing that independents are challenging more often than not.
Yeah, and I suppose that's interesting is 79% of transactions that have occurred in this first half of the fiscal year have been to independent purchasers. And by independent purchasers, I mean people buying their first or second dental practice. That doesn't include the tier 3 or tier 4 buyers, which means that remaining 21% is kind of the dental groups. But it's fair to say when we say dental groups, it's not the dental groups that everyone thinks of, is it, really?
No, I mean, the big dental groups actually have probably took a step back in acquisitions. What we're seeing is the likes of some of the biggest players out there focusing on their own estate, EBITDA management of their own estate, as opposed to acquisition to almost get them out of trouble. So the bigger groups are tending to only go for the dream practice, i.e. risk shared amongst multiple dentists. They can pick it up on a 70-30 deal, and they've leveraged their risk accordingly, where micro-consolidators can be a lot more generous in their offering and take on a higher or greater level of risk, meaning that they will likely put forward a better offer.
Yeah, I mean, I think the key thing is probably flexible is probably the word I'd use, because actually, what we tend to find is now, because the cost of debt has increased so significantly over the last couple of years, as we've talked about on umpteen of these various different podcasts, is that now groups are quite strict in their parameters about what they can do. So they have to put 70% down, because it's not necessarily de-risking, it's actually talking about the lending, because in essence that 30% deferred, they're not paying interest on, so they can pay that out of cash flows, which is why they're not able to be that flexible. Whereas conversely, if you're a tier 4 buyer and you're still going to a high street bank to borrow the money, or you're using cash reserves that you've built up from your existing estate over a number of years, and you've been quieter during sort of the really expensive debt periods, is actually, if you want to pay 100% on completion because you're quite comfortable with the principal leaves, you can run that practice locally, then you can do that. Or vice versa, you can negotiate a deferred, which may be more directly linked to a specific risk as opposed to a generic, I want 30% on the hook of the balance of the whole practice income.
Agreed. And just moving on multiples, and we don't really touch on multiples too much in these water coolers, but what we can see is in the owner-led markets and the independent market, actually what we're starting to see is buyers are paying a greater multiple on higher turnover practices. So if you've got a practice turning over 200k and you're fully private, is that multiple is significantly different than if you're a mixed practice or an NHS practice, which let's say a 700k. So why do you think that would be?
I think the main thing is, as you said at the outset, the groups are now a lot faster in terms of what they want to do. So they will go, they will sharpen the pencil, to use a very bank term, on deals where they feel, it is something they really, really want in their group. But what they're not going to do is they're not going to get out of bed for 150 grand of EBITDA. Yeah. Whereas when we went into sort of, the real periods of consolidation, they were fighting tooth and nail at, high multiples for 160 grand EBITDA. Yeah. Often in the belief that they thought they could grow that 160 grand to something like 250 250. But actually, I think what a lot of them have learned is actually achieving that organic growth when you've got a real big estate of dental practice is actually quite hard without someone on the ground. And I guess that's where the tier 4 and tier 3 buyers have started to come in their own, and because they can achieve that organic growth, because they have got the ability and that flexibility and manpower to put someone on the ground to be able to achieve it. So I think that's one of the big things, and I guess without belittling this or what we're doing in terms of making it boring, but actually the movements in this fiscal half of the year have been really quite modest. So even if we put if look at mixed practices, which has got the highest fair maintainable trade in the survey, and we're borne in mind that the FMTs are slightly misleading because of course it's only as good as the practices we're selling, so there will be quite a big variation. But generally speaking, FMTs for mixed practices were a good 100k up on private practices and NHS practices in this particular survey. So if you said that the average multiple for independent practices has only changed 0.06 of a multiple in the first fiscal year, that's only about 20 grand in purchase price. And the story is actually really similar as well for group practices. So again, we've had about a 0.1 reduction in multiple, but on an average EBITDA practice for say 250 grand, which is typically now the threshold where the groups start to be interested, that is in purchase price terms only about 25 grand. So the actual swing, whilst it's a negative swing, is actually quite modest.
It's quite modest, and what we've also got to look at is these are completions that happened probably when deals were negotiated at the time of interest rates fluctuating and increasing, and an element of the unknown with interest rates. So what we are seeing again on the ground is actually multiples are starting to improve, certainly from the independent market and for key strategic practices. So now that base rate is potentially looking to go down, obviously the budget may have an impact. Certainly all the signs look at multiples increasing over the next 6 to 12 months.
Yeah. And I think that will be largely hooked on what happened in the budget, which may actually now be after. So you'll all know this, we don't know this yet. But in theory, if capital gains tax goes up, as we predict it will do, I think you'll see a reduction in supply of practices coming to market, which then may indeed then through basic economics actually push prices and push multiples back up anyway. But I think potentially, just to end on one last point, the more interesting for me is that when we were doing these surveys 12 to 18 months ago, the average purchase price of a practice was about 1.1 million. And that's fallen now in this survey to 729,000. Now that's not because, as we've established, that because multiples have dropped, but I think it's probably symptomatic of, I think, a lot less bigger practices are coming to market. Would you agree with that?
Yeah, and I think that's just the bigger practices are probably subject to potential tax liabilities on changes of CGT, business asset disposal relief. So if you've got a practice worth £1 million, for example, you're probably not going to be hit in changes of CGT and business asset disposal relief the same as if you've got a practice worth £4 million.
Yeah.
So them sellers are looking to retain, find out what's going on with the budget and make an informed decision.
Yeah, and also I think it's also symptomatic of the fact that you've got, as I said, a busier end of the market, tier 3, tier 4 and independents, and they tending now are opting to buy practices where, to use an expression, there's something left on the table. So they want to buy those practices which are doing 600 or 700 grand revenue over 3 or 4 surgeries with a view to add to it. So I think what we're finding is, whilst there is less bigger practices coming to market, I think that's the point of fact, is that when they are coming to market, they're probably not necessarily as well received as they were, because what people want now is they want to see organic growth, and they don't want to pay for organic growth, and which means we're finding that kind of mid-market, as I said, that kind of 600 grand to £1 million stock is probably, I would say, the fastest area of the market at the moment, at this moment in time.
Brilliant, thank you for listening, and again, download the report when you can.